and welcome to our webinar. Good evening and good afternoon to everybody around Australia, and good early morning to those if you're dialing in from further afield, such as the UK. We are presenting today on an apt event, Expats in Australia and the UK, and the tax and other financial considerations that come with being an expat in Australia, or considering to be an expat in Australia. I will just share with you the general advice disclaimer to confirm with you that this presentation is not financial advice. It is of a general nature and only constitutes generally people's financial situations, but not specific individual objectives or financial situations pertaining to one particular family or person. So my name is Toby Simpson, and I'm a financial advisor at Apt Wealth Partners. And in my area of the business, we specialize in looking after expats. And we find that we come across a lot of UK expats. And joining me today is Bradley Murphy from Murphy Tax. I'll introduce you to Brad. Brad, if you would just like to say hi.
Thanks, Toby. Yeah, appreciate you having me on the webinar today, and looking forward to talking some UK and Australian tax matters shortly.
Darren is unfortunately not with us today. He's had to attend to a medical situation, nothing too serious, but unable to join the webinar. So the content of today, or the agenda for today, will cover some context. I'll talk about the context, and then Brad can talk a little bit about the tax agreement between the UK and Australia, and some differences that we find that are very obvious between both jurisdictions. The big question that always comes up is inheritance tax, so we naturally have to cover that. That's an important part of this. And then he'll go on to some of the tax aspects of retirement planning, property and investments, and I'll come back and talk about the UK state pension and the UK pensions. So just some sound bites, I suppose, in terms of the UK and Australia, just to give you some context. These numbers have been published, and we get a lot of people coming to Australia from the UK. 19,230 arrived in Australia in 2023, and I believe, whilst the numbers haven't been published, those numbers have increased considerably since then. I think there's a lot going on in the UK, and Australia is very happy to welcome Brits. And of all the Brits that live here, or all the UK people that have worked in the UK, they have in the UK over £1 billion worth of pension assets. So there's a lot of money sitting in the UK that belongs to residents of Australia, and there are many residents of Australia that are looking and seeking advice on how to manage that. 1.1 million UK expats are resident in Australia that own that £1 billion. And we find that UK expats are often unadvised, and the big issue here is that there's some serious complexity in that, and the Australian advisors generally don't touch this sector. Their preference is to think about their domestic advice and all of the things that come with Australians born and bred here and living here and continuing to live out in their retirement in Australia. When it comes to the expat, it's a different scenario and has its complexities, and so there's a limited amount of people with the right expertise to support that cohort of people. We tend to find, and I certainly come across these questions, and Brad and Darren do too, but these are the most common questions that we get. How do I access my UK pension capital in the context of living here in Australia? And then, can I get it here? Can I transfer it? Some of the pensions in the UK are defined benefit, and they come with a lovely and seriously appropriate guarantee for some people. And so people wonder whether they should keep it or not. And then the questions are around, well, I've been here for a long, long time, and I can't really remember exactly where my pensions are. And the company that used to have it is now the habit has changed, and perhaps it's changed several times. I may have more, but more pensions, but ultimately I don't have enough information on them. Can you help? And then the question is, do we transfer all of the pension capital in the UK as English people or people with UK pensions, British people, or do we draw down on it? It's a big question, and that's one of the things that comes with how much tax am I going to pay, being here and having Australian assets and UK assets and UK pensions. And the question mark around ISAs and property in the UK, and how do I manage that in a tax effective way? How do I receive income? Should I sell it, dispose of it, bring it over here? All of these questions are very common, and we field them and deal with them. And for financial advice covers a breadth of aspects. We're not tax lawyers or tax accountants, which is why we have a really good relationship with companies like Murphy Tax and Brad and Darren, and they come in and together we provide advice that is prudent and supportive of any changes in strategy or approaches to moving money if it's tax effective. So Brad, I'll hand over to you if that's all right, and you can tackle the first part, which is the tax agreement.
Perfect. Thank you, Toby. Yeah, looking at the UK and Australia tax considerations, obviously there are many and numerous. So we'll touch on the key, probably 5 or 6 aspects today during the webinar. And this probably applies to Brits looking to move down to Australia, considering a move down under, or you may already be in Australia or have been here for a number of years. I think all these factors are still very much relevant to you. So we'll look at tax residency in Australia and the UK and why that's important. We'll discuss property, what it means to have a UK property from Australia and how to manage that from a tax perspective. We'll look at your investments, so shares, ISAs, Australian shares, and how to best manage those. And as Toby mentioned, we'll also look at UK inheritance tax and the big changes in that space recently. And of course, retirement planning in terms of how to handle a UK pension and best bring that to Australia. So first off, there's of course a UK and Australia double tax agreement that does alleviate the majority of double tax, which is obviously good. However, it's important to realize that it does not effectively allocate or alleviate tax to one country. So it allocates taxing rights to the country of residency, in that the country of source provides or allows a tax offset to the other country. So the key point there is to realize that the tax treaty will offset double taxation, but you're still required to include that foreign income in the Australian return with a tax credit in your Australian return to offset the UK tax. So a common example would be if you've moved to Australia, you have a UK property that you're renting out, you're earning UK property income from that property, you would still be required to include that property income in your Australian return, but there'll be a tax offset for the UK taxes paid. So the tax treaty is important and relevant, but it also doesn't cover all taxes. There are some important mismatches that the tax treaty doesn't address, which we'll go through now. They're really 4, I guess, key points that it does not address. Toby, you're right to flip to the next slide, Toby.
Sure.
Yeah. So yeah, looking at some key differences between the two tax systems. Obviously, the first one is inheritance tax, which the UK has, Australia does not at this point, which is nice. In the UK, you can gift assets between spouses without triggering taxes. In Australia, a gift between spouses would be a taxable event. On death in the UK, there's an uplift to market value for tax purposes. In Australia, you retain the historical cost base for property and shares on passing. There's a big difference in the way the UK and Australia retirement funds operate. In the UK, you pay tax on the way out from your pension. In Australia, you pay tax on the way in at 15%, but you can withdraw your super tax-free once you turn 60. And the big one, which is very much relevant for Aussies, as they love their negative gearing and property, is that interest is deductible in full in Australia to offset any income, including your employment income. In contrast to the UK, there is a restriction on how much you can deduct from your mortgage interest, which we'll come to in a moment. I might just touch on, before we touch on inheritance tax, just Australian tax residency and why that is very important, because that does determine a lot of the tax outcomes that you will face in Australia. So normally you would be considered an Australian resident for tax purposes on your permanent arrival in Australia. So on the date of your permanent arrival in Australia, that's when you're inside the Australian tax net from that date. The exception being if you're on a temporary visa, which is a nice concession. So if you are coming to Australia on a 482 visa or a temporary skilled visa, you can actually be a subset of an Australian resident where you are a resident from your arrival date, but you actually ignore or exclude any foreign income. So for example, if you had a UK property or some UK shares and you're on that temporary visa, you don't pay Australian taxes on that foreign income while you have that temporary visa, which is quite nice. However, if you're on a permanent visa or you're an Australian citizen, you're effectively inside the Australian tax net from your date of arrival from that point, and therefore you would need to declare any UK income in your Australian return going forward. So I think the big one we see there, or perhaps the big omission we see there is, as I mentioned before, you come to Australia with a UK property that's been rented. You may have paid some UK tax on the property, but inadvertently omitted that rental income on the Australian return. So just be mindful that income is declarable in Australia with a tax offset, of course, for UK taxes paid. But we see that's a common area that some clients inadvertently forget to declare the income, and the ATO, they're relatively hot on foreign income at the moment. So yeah, just make sure your compliance is in order in that scenario. But yeah, turning into inheritance tax, Toby. Yeah, so there were some big changes in this space as of February this year. Previously, inheritance tax was basically based on your domicile. So if you're UK domiciled, that's when you're effectively subject to UK death taxes. This all changed this year, and instead, effectively, if you've been UK resident for the previous 10 years out of the last 20 years, then you're subject to UK IHT on your global estate. So that would include any Australian properties, for example, or Australian assets as well as UK citus assets. So that's a big change, especially for probably Aussies that have been in the UK for 10 years and are moving back to Australia. Just be mindful that this is really important to consider as part of your estate planning when you do move back to Australia. There is a tail period where you can actually break or stop being subject to UK IHT. That period is between 3 and 10 years, depending on how long you're living in the UK for. But it is possible to move to Australia for between 3 and 10 years and actually break your UK IHT status on your Australian assets. This is called the tail period after you leave the UK effectively. But of course, any UK property, given it's a UK citus asset, does still remain subject to UK inheritance tax. There are some concessions. Sorry, Toby, I think I jumped that slide. You can effectively ignore the first £325,000 from your estate. You can transfer that between spouses. And there's also a main residence exempt ban of £175,000 too. So when all is said and done, effectively £825,000 can be tax-free from UK inheritance tax. There's also gifting that you can do, where effectively you can gift assets, and if you survive 7 years, they're outside the UK net as well. Bit of a morbid topic, so we won't dwell on that too much, but I think for now it's just something to be very much mindful of if you move down to Australia.
So can I just ask, Brad, so if people are leaving or have recently left the UK and are here in Australia and they have, they have a lot of assets all over the world, but importantly here in Australia and in the UK, they fall into this this tail, this net for a period of time, depending
E-
on certain considerations. That's what you're saying, isn't it?
Yeah, exactly right, Toby, which is a big change that happened this year with these new rules. Yeah, previously, if you were living in Australia with Australian assets, or you'd been in the UK for a number of years on a short-term basis, if you weren't UK domiciled, so really born in the UK or had been in the UK for sort of 15 years, your Australian assets weren't subject to IHT. But this new law means that if you've been living in the UK for the previous 10 years, then the starting point is that your Australian assets would form part of your IHT estate unless you live or move out of the UK for up to 10 years. So this tail period, yeah, is between 3 years and 10 years, depending on how much time you spent in the UK. So you can lose that IHT status.
Yeah, so I suppose the good thing is that you know that there is a finite period to this, as opposed to before. There seemed to be some approach to considering people still as domicile, but domicile is gone.
Exactly right. Exactly right. So I guess it's probably good and bad news depending on what boat you're in. It's probably not great for Aussies that have been in the UK for 10 years and coming back to Australia. At the same time, there is now a way to escape that sort of IHT liability by moving to Australia. So yeah, I'd say there's a bit of a silver lining perhaps for those Brits or Aussies coming back to Australia.
Yeah.
Yeah, yeah.
Okay. Thanks.
Never,
Okay. I
never a
mean,
nice topic to talk about, but something very much relevant for everyone, I guess.
yes,
Yeah,
certainly. Shall I move on to the next one?
yeah, please do. So yeah, we touched on this before in that even if you have UK based assets, so yeah, UK property, UK ISAs, UK shares, just be mindful that once you do move to Australia, those UK assets do come into the Australian tax net from that date. So even though they're actually based, overseas in the UK, the fact that you're residing in Australia does bring them into the Australian tax net from the date of arrival. The common examples there is a UK pension, which Toby will talk about in detail in a moment. And of course, UK property income we spoke about. There is some good news is that when you do move to Australia, you get a new cost base for capital gains purposes when you do move to Australia. So you get a market value uplift to the cost basis of those UK assets, which would include UK shares, UK property, UK ISAs all get uplifted to their market value for capital gains purposes. So capital gains would only apply from the increase in value after you move to Australia. And we'll come back to that a bit later on, what that means in practice with some examples. So property, massive topic, obviously, for Brits moving to Australia that retain a UK property. The important one's going to be if you do sell that property in the UK, just be mindful there'll be both UK and Australian implications to consider on the sale from a capital gains perspective. Given it's UK property, the starting point is that the UK would tax it first. There would be some concessions for the period you lived in the property as your main home. So you can exempt that period from UK taxes, but effectively the period after it's been rented is a taxable period in the UK. Now there'll be a credit in Australia for UK taxes paid, so there's no double tax there to worry about. But I guess with the exchange rates, you sometimes see some funny things happen here when sometimes the Australian tax can be more than the UK tax. But the nice thing is, as mentioned before, you get that rebasing for Australian purposes when you move to Australia. So any Australian tax on the property will only be from the increase in value upon arrival in Australia. So normally it's not too bad from an Australian perspective unless you've been in Australia for a long time. And we've covered the rental income before, so I might just jump over that one. But if the property is rented, just be mindful that the UK rental income is taxable in Australia at your marginal tax rate in Australia, which will often be a bit higher than that in the UK. Normally, when you leave the UK, your tax rate would fall. So any UK tax on the rental income would be a lot lower than the Australian tax rate, given often you have employment income and other income in Australia, which can make the effective tax rate on UK property income, up to sort of 30 to 40% in Australia. And yeah, so just back on the property, sorry, Toby. If we're looking at Australian property too, obviously, very common for Brits to come to Australia and buy a home in Australia. which certainly can be done once you've got your PR or become a citizen. Unfortunately, at the moment, there's a temporary ban for non-residents buying property of Australia. So if you haven't got a PR in Australia, unfortunately, you can't buy property for the next couple of years. But yeah, once you get your PR, you can buy a home in Australia, and the home you live in is free from Australian taxes, which is a nice concession. Negative gearing, sorry, for looking at investment properties, obviously a major source of wealth in Australia, and every government policy is designed to really prop up the Australian investment market. So negative gearing, where you can deduct the interest on the mortgage to offset your employment taxes, is huge in Australia. There's a long-term 50% discount on the sale of investment properties in Australia. So every real government policy at present is really designed to make Australian investment properties quite attractive. I mean, that may change going forward, but so far the gravy train rolls on. Yeah, do you want to maybe cover the investments now, Toby? Yeah, cheers. Yeah, so we spoke about this before. If you are coming to Australia with investments, as I mentioned, you get that new cost basis when you move to Australia. So any Australian tax on shares or managed funds is only from the increase in value after you move to Australia. And also the UK does not tax non-residents on the sale of shares or investments. So that can be quite a nice outcome in that you can really escape, let's call it, CGT on that gain you've made living in the UK on certain shares and investments. So there's a bit of an upshot there in moving to Australia from a capital gains perspective with shares and other investments. The ISA is a big one that does change when you move to Australia. An ISA is effectively an individual savings account, which is a tax-free wrapper in the UK, which normally holds cash and shares. And you can put up to, what, £20,000 per year in there, I think, Toby, at the moment. That
Yep.
that accrues tax-free in the UK. But just be mindful that when you do move to Australia, Australia would tax that from any future earnings or growth after you've moved to Australia. So it does move from that tax-free environment to a taxable environment on the move to Australia. Investment bonds are very popular for Brits moving to Australia, in that Australia allows a very nice concession where if you hold that bond for at least 10 years, you can pull out that investment bond free from Australian taxes. And whereas the UK would tax you on the bond, they're normally held offshore. It's quite common there in the Isle of Man or Jersey or Guernsey, somewhere fancy like that, because they basically accrue tax-free earnings there offshore. So I think it's certainly something to look at from a tax perspective. Toby can jump in a moment about the investment merits of them, perhaps, but certainly from a tax point of view, they're quite friendly if you are looking to hold that bond for 10 years, in that you can cash them free from Australian taxes under the current Australian law. There's always a bit of a whisper about the Australian government changing that one in terms of the policy around having that 10-year tax-free wrapper, which I think is always a possibility. But at the moment, anyway, you can cash it out 10 years after the purchase date. I mean, the other one would be the structure to hold the investments when you come to Australia. It's very common for let's call it higher income families or individuals to set up an Australian structure to hold the investments, which could be an Australian family trust or a company in Australia as well. So they're probably a bit more common than in the UK to have the investments held in a trust structure or a company structure. Gives a bit more tax benefits, and there's an asset protection benefit there, having the assets held in a trust. Yeah, thanks, Toby.
All right. Okay.
Yeah.
Thanks, Brad. I'll
Yeah.
I'll take over and talk a little bit about some of the pension situations that we find ourselves in as expats in Australia. So first of all, I'll talk a little bit about the UK state pension and what it means to have been in the UK and potentially have contributed to the National Insurance Fund with your contributions. So to qualify for the UK state pension, you need to be able to have 10 years of national insurance contributions. And in most cases, you can back pay as long as you have paid you've had 3 continuous years living and working in the UK and have paid those 3 years. There's also the need to pay 35 qualifying years in order to allow you to qualify for the full pension, which is currently £230.25 per week. And the interesting thing is, unlike Australia, it is not means tested. So anybody that has paid the national insurance is able to claim on the UK state pension. It's sensible generally to top up. We're often asked the question, should I back pay? Should I continue to pay as a resident of Australia? Should I try and find out what my options are with the Department of Work and Pensions? And so the answer in my mind is firmly yes. Ultimately, topping up increases the weekly pension entitlement, and I've put here by up to £6.57. And you've got two options. You can either qualify to pay class 2, and generally that's if you've been self-employed in the UK or you have had continuous employment since leaving the UK and have arrived here. There's some relatively strict criteria, and you can see there's a big difference in what you would have to pay in order to get the £6.57 per week extra. But most people would qualify for class 3, and even if you're paying £923 as a current rate for an annual increase, you would still, in theory, break even if you were able to receive the pension for more than 3 years. So if you started receiving the pension at 67 and you survived past 70, which are obviously highly likely, it's clearly very much in your interest to try to top up as much as possible. There are limits on the number of years that can be bought, and obviously that pertains to your situation. They've changed the rules a lot recently, and so it's probably important to say that as of April this year, there's some limitations on what you can back pay, and obviously you can continue to pay for future years if you have the time. When you become an Australian resident and you become of age and are able to claim the state pension, the amount that you claim does not increase by CPI if you are a resident of Australia. So if you're going to get today £230 per week, you will be getting £230 per week forever. And the money that you receive from the Department of Work and Pensions is received as a gross amount and is taxable in the UK and Australia. Now, depending on your tax situation in the UK, you can not have that taxed at source, and it can be taxed in Australia. And ultimately, what we would say to you is, if you were receiving the full pension now and you weren't receiving any other income in the UK, then you're just under £12,000, and that would be within the nil rate band. The equivalent of that today would be $24,000. And again, if you're not earning any additional taxable income as a pensioner here, there would be very, very little tax on $24,000 of income. So I'll talk a little bit now about UK pensions, not the state pension, but the UK pensions that people might have, and those being defined benefit pensions, workplace pensions, SIPs or self-invested personal pensions with all the various companies, the pension providers in the UK. And many people have several, some defined benefit from when they started work that still exist now, and some that have converted to other types of pension. But essentially, there are many different types of pensions, and I just wanted to give you some idea as to some of the high-level considerations, and then talk a little bit about the complexities of living here and what we must consider. So you can access a UK pension from the age of 55, which is obviously 5 years earlier than you can access your superannuation. And that may well be very helpful to you. Benefits that are paid from the UK. So if you are retaining a UK pension and you take, you put it into drawdown and you take benefits from the UK, they are taxable in the UK and taxable here. Again, if you are not taxed at source, you have a nil tax code in the UK, which you can achieve by completing a particular form, the double taxation form. You would only then be taxed here, and clearly, the big question is, should I be taking benefits from the UK, or should I be transferring it here? And in some cases, pensions have to remain in the UK. Most pensions can be transferred, but there are some that are unable to be transferred. They're called unfunded pensions, and they are pensions that are paid from current government revenue rather than invested funds, such as the NHS or the teachers' pensions, or civil servants and the armed forces pensions. So those would generally pay out on a defined benefit basis, and as a result of that, that's a fixed number that would come out, and that creates potentially a taxable situation. And that is just one of the vagaries of having those pensions and living here. If you were living in the UK, you would be taxed in the same way. As we know, pensions on the way out are taxed in the UK, as opposed to having them here if they're transferred, and then being able to take pension tax-free out of the superannuation system. So UK pension capital, if it remains in the UK, whether you are pre-55 or over 55, if it is there, it can be managed from Australia. And we find that a lot of people are more comfortable with having UK pensions that are managed by their financial advice team in Australia. And in some cases, they can be converted to Australian dollars and invested in Australian assets and be ready to be drawn in Australian dollars, and sort of remove some level of the currency risk. So I suppose what I'm saying is, whether you've reached 55 or not, if you have pensions in the UK, they can be managed here. And if the decision is not to transfer them after the age of 55, they can continue to be managed. And usually that's based on tax and decisions around, being able to get it into Australia, and perhaps with the limitations that Australia imposes on transfers, which I'll talk about in a little while. So the jurisdictional piece is clear. There are, with having UK pensions, you've got to consider the rules in the UK and the impact of those on you as a resident of Australia. We've talked about one, which is if benefits are paid from the UK, they're taxable in Australia. If you were to move a pension over here, the ATO would look to tax you on the earnings since you arrived. Brad talked about becoming a tax resident on the date of arrival. So if you've been in the country for 10 years and your tax residence started back in 2015, then any of the earnings that the pension in the UK has received since 2015 would be taxed in Australia, and those earnings are called applicable fund earnings. And you can essentially transfer the pension to a scheme in Australia, and that scheme must be a qualified, recognised overseas pension scheme. And there aren't very many of them. In fact, there is one fund that is available, one super fund that is available on a retail basis, and then there is the self-managed super fund, which has a specific deed qualifying the rules that HMRC bestow on a scheme that is notifying them that they are qualified. One of the big reasons being you can't have any members under the age of 55. So that's the reason why all of the super funds in Australia are now no longer able to be a QROPS. But as a result of moving that money to Australia, there's potentially going to be some applicable fund earnings taxes that are paid, and you can elect to have those taxes paid by the super fund if you move the money into the super fund. And in fact, if you move all of the money, i.e. you can't elect to have the super fund pay the tax if you leave money in the seeding pension scheme. So generally we find that advice is always to take the full balance and move it all at once. And that way you can elect to have the applicable fund earnings tax at 15% rather than your marginal tax rate. Once money is here, and I suppose this this is appropriate if people have an SMSF. There are reporting responsibilities back to HMRC, and so there's some complexity in managing that, which is one of the reasons why advice and the right accountant and the support behind all of this is so important. The other thing to say is that the UK has a limitation on the amount of money that can be transferred across to a super fund in Australia in terms of tax. So it does, if you are transferring up to 1,073,100, you wouldn't pay any tax in the UK. Any balance over and above that is taxed, and that sort of exceeding of the overseas transfer allowance of that 1 million number will incur a 25% tax on the excess. So there's some of the, I suppose, the vagaries and complexities of the dual jurisdiction, and there are many more. The slide would go on forever, and I'd be talking to you, in detail, which I think is probably for another time. It suffice it to say, it's probably very important to think about these aspects and consider advice. So I'll just give you the main strategy that we find we use and that most people who are transferring pensions look to try and implement. Usually it's transferred to Australian superannuation. Sometimes it's not transferred to Australian superannuation. Sometimes it's beneficial not to do that. But usually it is, and it's usually the self-managed super fund, because it gives everybody a lot of flexibility and control. The transfer is usually in full from the UK pension, i.e. it's not, you may have heard, or there are other strategies where pensions are split so that you can take one pension in the UK and make it two and transfer the one so that it fits with the limitations, potentially the non-concessional contribution limits that super bestows on people here. We tend to find that the advice is better placed to bring the whole amount over in one go. A lot of that is predicated on the approach that the ATO take on the applicable fund earnings and any money that's left behind, and subsequent transfers can create a more or rather a less tax effective outcome. And when you transfer the whole pension, often it is in excess of the non-concessional contribution. So the non-concessional contribution would be $120,000 a year, and you can commute 3 years into one. It's called the bring forward rule, and you would be able to therefore contribute up to 360,000. And so anything above that, excluding any earnings that the pension has made since you've become a resident of Australia, the excess is not really meant to stay in the fund. It is perfectly legal and normal for it to arrive as an excess contribution, because we're wanting to bring the whole lot over at once, and the ATO understand that, and that's a very normal approach to bringing over a UK pension, especially if it's a defined benefit pension where the defined benefit scheme is transferring the full lump across to Australia. But the ATO will say to the trustees of the fund, there's been an excess contribution, and they'll give the member the option to either release it or keep it in the fund. If you keep the excess in the fund, there is a 47% tax. So nobody keeps the money in the fund, they release it. And I'll show you the benefit of that in a minute with a case study. But what we find is that the release comes out after the end of the tax year that the payment, the transfer was made, and it comes out of superannuation along with some deemed associated earnings. And that is based on a rate of interest that the ATO prescribe. And so if you've had an excess contribution of 200,000, for example, and you've had it in the fund for over a year, and the ATO is looking to charge you or is looking to charge you on a deemed earnings rate of 10%, on 200,000, you've earned 20,000 of interest, let's say, of earnings, and that will go onto your tax return at marginal rates. There's some complexities to it and some detail behind it, but essentially that's what happens. And so you might ask, well, why would we do that? And essentially that's a more tax effective way of getting the money across. And whilst there is an excess and there is tax on at marginal tax rates on that excess, you find that if you put side by side leaving the money in the UK and paying tax on it as it's drawn out, it being much more effective to do it in one go and transfer it. So I thought I'd just share a case study with you. This is an actual case study that I dealt with a few years ago, where we had a chap and his wife, John and Susan, 56 and 57, with 2 adult children. He recently retired. Actually, he was made redundant, and he got quite a large lump sum from his company, BP at the time, and that was enough to allow them to live for a few years until they met a condition of release to access their super. But John had these 2 UK defined benefit pensions with significant transfer values, and he wanted to know what he should do, how he could bring it over, what the tax position would be, and if he could get access to it, knowing that he could, in theory, get access to some of this money in the UK from 55, and wanted to understand the tax consequences of all of that. They both had super accounts, and they both had a large mortgage that they were planning on extinguishing by the time they were due to retire in their early 60s. Things accelerated as a result of the redundancy. So the pair of them sat with me and said, look, this is what we want to achieve. We want to realize the value from the UK pensions, as the impact on the death of John would mean that the current arrangements would pay out 50% of the defined benefit to Susan. And they felt that that was an awful lot of money to lose if something happened soon, some tragedy happened earlier in John's life. So that was the sort of the real reason, the main reason why they wanted to move the money. But they also wanted to have tax effective management, because he was going to be forced to take to a taxable event in the form of taking these defined benefit payments every year, and this was in the sum of around $70,000 to $80,000, and he was going to have to pay tax on anything, on a considerable amount over and above the nil rate band. And this was going to potentially go on for 20 or 30 years, and this seemed tax ineffective. So they wanted to understand the differences between running it that way and actually transferring it over to Australia. They really wanted the pensions over here. They wanted to consolidate the retirement capital, but they also wanted to understand how they could get access to money, and they were nervous of running out of money before Susan turned 60. She was a year older than John, and she would meet a condition of release and they could start accessing super. And this was all in the vein of hoping not to go back to work. And they've also got this home loan that they wanted to extinguish. So they were thinking, well, we need to get some of this money out of the pension environment, either super or the UK, to help us extinguish the loan. So we provided some advice, and the upshot of this was that as a result of the advice, they transferred the pensions, and they had access to capital and a much greater control, because they were able to decide whether they wanted to have a certain amount of money coming out of their retirement pot every year, as opposed to being dictated to and being taxed on it. Transferring the UK pension capital to Australia allowed them to pay down their mortgage sooner, because they transferred in excess of the non-concessional limit, and therefore there was a release a year and a bit, just a little over a year later, and the release was significant based on those numbers. And so they were able to immediately pay down their mortgage, and John was not even 58 when they paid down their mortgage, and so they reduced that cost, and they were able to have access to additional money that had come from the UK pension release after the transfer. They reduced their overall tax liability, and they were able to consolidate all of their money into one place, which happened to be an SMSF, and so they saw that as a simple outcome, and were able, with our support, to see that being managed and continue to be managed. And with the funds being in Australia, the income tax that they would have incurred on fixed withdrawals goes away, and they now live with all of their money in superannuation, and they've paid off their mortgage, and the income that they get from their retirement pot is now tax free. So what would be the alternatives to transfer? I've touched on it, but defined benefit pensions are, it's not a given that you should transfer a defined benefit pension. In fact, perhaps quite the opposite, because for many people, a guaranteed CPI benefit, so a payment every year that goes up by CPI, creates a lot of peace of mind, and you know where you stand. You can cut your cloth according to the income that you're getting. So if you're getting an income on that basis, and you feel that it's more appropriate, even though there might be some taxes, it's guaranteed, and you're not at the behest of the investment markets. Once you've taken the money out of a defined benefit pension, then there's a lot of merit for retaining these wonderful guaranteed defined benefit pensions. Leaving a pension in the UK and withdrawing it slowly, with hopefully a nil tax code in the UK, which means there's no tax at source, is helpful, and you can get access to your money from the age of 55. But it comes with the vagaries of tax, and that needs to be measured, and it also comes with a significant UK IHT issue. And as of last year, when the budget was announced, they stated that as of April 2027, the UK pensions fall into the IHT net. A lot of people used to use UK pensions as a place to hold money outside of the IHT net. Now that's no longer the case, and so leaving it there could easily create a significant taxable event for the pension, and therefore the inheritance for the heirs. And to boot with that, if the person who leaves the pension behind has been over the age of 75 when they pass, the heirs will be taxed at marginal rates in the UK. So it's a bit of a double whammy. I mean, you could argue that 70% of the pension might be taken in tax. So these things need to be considered in everybody's situation, and they are considered when advice is provided. So I think I'll leave it there, and we've got a few minutes if there are any questions. Not that I've seen any questions come through, which is absolutely fine. And obviously, if there's any interest in sending questions to us, we would be delighted to hear from you, and you are able to contact us directly, either Brad or myself. I think I'm finished, and I hope that was of value. Brad, have you got anything further you want to say?
That was off my end as well, Toby. I think just one more closing point. There is a budget, the autumn budget coming up November 26th in the UK, which is meant to be sort of designed for the working class, so to speak. So I think there might be some more changes there. Probably higher taxes on the capital gains front, I suspect, and perhaps further clampdowns on inheritance tax as well. So I think just watch that space carefully as well in a few weeks.
Great.
I've got one
Okay.
question that just came through.
Yeah.
Toby, please can you recap on the tax treatment of a property from a rental? Yes, of course. Yeah. So if you are living in Australia and you own a UK property that's rented out, the starting point is that the net rental income from that property is included in your Australian tax return and taxed at your Australian tax rate. So you can deduct obviously all the expenses, so repairs, maintenance, depreciation, interest against the income, but that profit is what's taxed at your Australian tax rate. And that income is effectively added to your marginal tax rate. So if your tax rate in Australia is 35%, you pay Australian tax at that 35% band on the UK profit. And normally, in this case, there's probably no UK tax payable, given you get a tax-free allowance in the UK of £12,500 on the rental income, unless the UK profits are above that £12,500. The way the numbers normally flow, that any UK tax would be small or sometimes no UK tax on that rental income from a UK property.
Okay. And then Clive, you've asked, I think I understand what you're saying. UK pensions revert to max if you go there, if you go and live there. So in other words, I think you're talking about the UK state pension, that if you moved back to the UK, you would be able to qualify for CPI again. Yes, you would. And how long you would have to stay there, I'd have to find that out. Sorry, I can't give you the answer. Is that how you interpret that, Brad?
Yeah, I do, Toby. I'm not sure as well. Sorry, off
I'll
the
get
top of my
back to
head.
you, Clive, on that, if I
Yeah.
may. I'm pretty sure that even for a short time, you wouldn't be deemed a UK tax resident or a resident of the UK, and therefore you probably wouldn't necessarily qualify for CPI, or to revert to if you were receiving it as a resident of the UK.
I think
And
so too.
and maybe Brad, if you answer Simon's question, that's on inheritance tax.
Yes, yep, good question. It would depend a little bit what the assets in question we're talking about, but if it's, for example, UK shares, UK ISA, a UK property, probably more relevant. There is sort of good news, I guess, on the tax front that that property would come into the Australian capital gains tax net for its market value at that time. So there'd be an uplift in the value of that property for Australian tax purposes. And there's no Australian tax on the actual inheritance at that point in time of passing. So that would mean, yeah, going forward, any Australian tax would be on the increase in value of that UK property or shares. If it's a cash inheritance and it's not taxable in Australia. The more complex issue would be if it's coming from a UK trust. That's where it does get a lot more complex, but normally relatively easy from an individual estate. I mean, subject to the UK inheritance tax on the UK resident, of course, which is perhaps the more important point. Um,
Another couple of questions there.
yeah, so okay, yeah. So if we moved on the PR, sold your house. Yeah, so really good question. So you need to look at both the I guess the UK and Australia tax applications on selling the house in 2 years. So I guess if you came on a temporary, or you're saying a PR, so Australian tax would only apply from the increase in value after the PR date. So you'd get a market valuation done on the PR date. Any Australian tax on the property would only be from the increase or decrease in the property after the PR date. Obviously, got to factor in the exchange rate movements as well. There'd be a discount of 50% to reduce the gain as well by half. You can actually claim the Australian main residence concession on the UK property if you didn't have a home in Australia at the same time. So it may well be completely exempt from Australian taxes. On the UK side, you would get the UK main residence concession for the period you lived in the home as your main home in the UK, and there will be some UK tax to pay on the period where it was not your home. So when it was rented, there might be a pro rata capital gains tax liability in the UK. Just be mindful that even if you live in Australia and you sell a UK home, you've got to tell HMRC within 60 days that you've sold that home and pay tax as well within 60 days. So just watch out for that short time frame to pay HMRC as well.
Ben's question, he's talking about whether you can nominate a different date.
Yeah, that's a real good question. Very common one too. Because the Australian tax residency rules are different to the UK in that they're not as black and white. It's a more subjective test of your residency towards Australia. I mean, normally it's the date when you obviously arrive on a permanent basis. So if it's you and your family come to Australia and you've got a lease or you buy property in Australia, or you start working from Australia, it's almost always from that date. But it perhaps, and the system is self-assessment, so you do nominate when you commence your Australian residency on your Australian return. So perhaps if you were sort of visiting in Australia before you actually had settled roots in Australia, you could argue that that date could be later in time, perhaps. But yeah, maybe just reach out, Ben, for a quick consult, and we can discuss that in more detail.
And Tom, you've asked if there's a recording. Yes, there is, and you should get it. But I'm just putting my email in the chat just in case you want to take that down and you don't end up receiving it for whatever reason.
Yeah.
I don't think there's any other questions.
Yeah, but yeah, I mean, as you said, Toby, if you've got any more questions, please feel free to reach out to Toby or myself, and we'll get back to you with the answer.
Great. Well, thanks everybody for attending. It was fantastic. Oh, sorry, Kathy,
Oh,
can we quickly answer that one?
Yep. So if we're talking about a UK home, I think, Kathy, good news is if you're on a temporary visa, probably no Australian taxes to worry about, which should be good news on the Australian tax side. Perhaps Toby can answer the investment.
Yeah, well, I suppose
Yeah.
all I would say to that is if the proceeds of the sale are sitting in the UK, it's really, a discussion around whether you're comfortable to change it into, well, you don't have to change it into Australian dollars. It might be sensible to change it at this stage, being nearly two Australian dollars to one. But yes, you could easily invest it in Australia, and then in the future, if you go back to the UK, you can take it back with you. Generally, you'd find that you're not going to get financial advice from the UK by a UK advisor living in Australia. So that's difficult for you because they generally don't provide advice for non-residents anymore. And if someone like myself are advising you on UK assets in GBP, there's limitations on the sort of the scope of what we would have available to invest in, much less than if you had it in Australian dollars and we were able to provide advice on an Australian dollar platform, for example, and investing in Australia. I hope that helps. So I will end the webinar there. Thank you very much, everybody, for joining, and I hope you have a good rest of your day. All the best.
Yeah, all the best.